Welcome to this video where we are going to review the Hips and Co break-even question, which was a multi-part question that we spoke about at the end of the break-even part 1 video. As a reminder, I told you about my list of break-even rules that I use in order to go about calculating break-even examples. And as I work my way through Hips and Co, I'm going to reflect back on these rules and I'm going to show you how they come into play and why they are important. So specifically, rule number 5, which is this calculation here of the volume, taking the gross profit divided by the margin, that for me is the golden rule. Always need to remember that you need to create the information, or you need to develop the data so that you can do that calculation. So let's bring in the Hips and Co spreadsheet here and let's start to explore some of these questions. So in the first question, question A, the data that was given to us as part of the question brief was that the selling price per unit is 40 and the cost per unit is 30. So therefore we can conclude that the gross profit is 10 Rand. Okay. Now I have drawn up here on the left hand side my income statement grid. So that was rule number 1. And this information here is part of the given data, which I've put into the grid. And rather than draw the grid over and over for each question, I'm going to use it once and we're going to work from left to right answering each of the questions in the multi-part question. A little bit later on, I think under part D, information is given to us about tax, and I've put that in there, but we'll talk about that shortly. In question A, we are told that the fixed expenses in this business are 50,000. And question A is specifically asking us to calculate the break-even in sales. If we're going to put the expenses of 50,000 in there, that's part of the given information in the rule set. The next piece of information here, which was rule number 3, is to say the profit before tax is 0. So we can plug that in. That's because this is a break-even question. At the point of break-even, notice how the gross profit and the expenses must be the same. So now we have this critical data here. We know our gross profit and we know our margin or profit margin per unit. And 50,000 divided by 10 gets us to 5,000 Rand in volume. Correction, 5,000 units in volume. It's not a rands measure. Once we've got the units, we can say units times selling price in order to get the sales required to break even. And then we can say units times cost of sales in order to get the cost of sales total. Also, for correction purposes, we can say units times cost price gets us to cost of sales. And now what we've done is we've completed the income statement that describes this business at break even, and I have specifically highlighted the answer that was asked for, or the data that was asked for in the question. In question B, we are given information about the sales that we want to achieve. And the question asks us to calculate the profit that we would make on sales of 400,000. So this 400,000 now becomes part of the given information that we can put into the income statement. And since we know the sales and the sales price, we can say 400,000 divided by 40 gets us to the units immediately. And once we've got the units, 10,000 times 30, remember 30 was given, gives us 300,000 Rand in a cost of sales. And 400,000 minus 300,000 gets us to 100,000. Less the expenses of 50,000 gets us to a profit of 50,000, and hence that's the number I've highlighted. So in question A, we actually worked our way up the income statement to get to the 200,000. In question B, we were given the 400,000 and we worked our way down to the profit. In question C, they said to us, what if we set ourselves a target to make 40,000 rands worth of profit? What sales would be required? So the 40,000 rand now is part of the given information. And the fixed costs haven't changed. So we're working from the bottom up to the top, and 40,000 plus 50,000 gets you to 90,000. Once you've got your gross profit, divide it by margin to get to units. Units times selling price gets you sales. Units times cost price gets you cost of sales. And we've worked our way up now to the 360,000 rand in profit that would be in sales that would be required to make a profit of 40,000. I like to call this, or these calculations that we're doing here, I like to call it income statement gymnastics. We're going down, we're going up, we're going down, or vice versa, whichever way it's happening. But we're working our way up and down the income statement and doing the maths of the income statement. Let's move on to question D. So in D, they specifically gave us this profit after tax number of 20,000, and they asked us to calculate the sales required. So there's a little trick that we need to get from profit after tax to profit before tax, and I've put some data here to help us with that. So a 25% tax rate can be represented as 0.25. Our profit before tax, I've said that is 1, or if you want, you could say that is a percentage, and that is 100% of our profits minus 25% will be left with 75%. So this data is quite useful now, because if I take the 20,000 rand in profit after tax, I need to get to a profit before tax. Now be careful here. You can't say 20,000 plus 25% to get up to the profit before tax. Because when you have the profit before tax, you can minus 25%, that works, but adding 25% doesn't get you back to the start. Test that for a moment if you want. What we need to do is take the 20,000, turn left here, and divide it by 0.75. 20,000 divided by 0.75 will get you to the profit before tax. It's as if it jumps you up a level. The difference between these two is the tax. Once you are at the profit before tax, add the expenses to get to the GP. At gross profit, take a left, divide by margin to get units. And units times selling price gets you sales. And there we've been able to work our way from the profit after tax all the way up to the sales. In the next question, question H, they said to us, if we increase the after-tax profits by 5,000, what will be the increase in the sales? So take the 20, make it 25. Repeat the process that we did for D. 25,000 divided by 0.75 gets you all the threes here, profit before tax. Add the expenses to get to GP. GP divided by margin gets you units. Units times selling price gets you sales. What is the increase in sales? And there is the answer, 26,667. So what that means is, if you want to increase your after-tax profits by 5,000, you have to increase your sales by 26,667. In question F, They say to us that the fixed expenses have increased by 4,000 Rand. So the moment I see an increase in the fixed expenses, I calculate a new break-even calculation. So I want to understand what sales is required at this new fixed cost. So if we use our break-even rules, our profit is 0, our fixed expenses are 54,000, and at break-even, the gross profit and the expenses are the same. GP divided by margin gets you units. Units times selling price gets you sales. So just notice that the increase in fixed expenses from 50 to 54,000 produced a break-even sales of 216,000. Back here in question A, the 50,000 expenses produced a break-even of 200,000. What is the increase in sales from A to F? The increase is 16,000. So this tells me that if I employ someone else in the business and it incurs an extra fixed cost of 4,000, I have to do an extra 16,000 Rands worth of sales to cover both the variable cost that goes with the extra units and the salary in order to end up at a break-even. This can be very useful in our planning in a business around what if you're renting more space and employing more people, incurring extra fixed costs, how will it impact the amount of sales that you need to do in order to break even. In the last question, question G, we are told by the marketing department that they expect to be able to run a marketing campaign where they will achieve an extra 80,000 Rands worth of sales, and they want to know how much money can they have as a budget in order to run this campaign. So what I did is I said, well, let's take our original break even. So let me hide these. Let's take our original break even and add 80,000 to that, because that's what's being promised to us. So we can then take the 280 divided by 40, and we're going to get a new volume of units that we're going to have to produce to make this sales target. 7,000 units in production times the cost of production gets us to 210. 280 minus 210 gets us to 70. So this is the kind of the manufacturing component and the sales that we expect to produce. If at this stage we make the assumption that our marketing campaign will cost us nothing and therefore our fixed costs remain the same, we will make a profit of 20,000 from the extra 80,000 that we produce. Now we have to pay for the marketing campaign. It doesn't come for free. Now how much are we prepared to pay so that we are no worse off than our break-even position? And that is what's being asked in question G. So then you might say you won't pay more than 20,000, because if you paid that money and you made it part of the expenses, your profit would then be 0 and you would be no worse off. Right, so that brings to an end the Hips and Co break-even example. I'm going to suggest that you go back and practice it a few times and look for some other examples that are in the folder. There's another one called ABC Limited, which is along the similar lines of Hips and Co, and practice this a bit more. And in the next videos, we will move from a single product business into a multi-product business where we can still continue to apply our break-even rules.